Hello everyone, welcome back. Today I will explain the capital asset pricing model, commonly known as CAPM. In this presentation, I will focus on the Sharpe-Lintner-Mossin formula and the security market line. These concepts are very important because they explain how risk determines expected returns in financial market. Let me briefly outline what I will cover. First, I will explain the core theory of CAPM. Then I will discuss beta and risk measurement. After that, I will explain the security market line with graph interpretation. And finally, I will show how CAPM works as a pricing model. Let's begin with the basic idea of equilibrium. In capital asset pricing model, we assume that an investors hold the market portfolio. This portfolio is efficient, meaning that it gives the highest possible return for a given level of risk. Another important concept is aggregate risk tolerance, which represents the overall risk preference of investors. The key takeaways is an asset's risk is determined by how it affects the market portfolio, not by the individual volatility. Now let's talk about the core theory of Sharpe-Lintner-Mossin formula. The key concept of this theory is in an equilibrium market, the market portfolio is the only efficient risky portfolio. It reflects the aggregate risk tolerance of all investors. The risk premium of any assets is determined by its covariance with the market. The key equation of this theory is ERI minus R is equal to beta I into ERM minus R, where I is equal to 1 to n. The fraction in the previous equation is called beta. Here beta I is equal to covariance Ri Rm by variance Rm. Beta measures systematic risk or market related risk. Let's interpret it. If beta equal to 1, this means as asset move with market. If beta is greater than 1, assets is more risky. And if beta is less than 1, asset is less risky. So beta tells us how sensitive an asset is to market movement. Now let's think critically. If beta is the sole measure of risk, what happens when beta is not constant? In capital asset pricing model, it is assumed that beta is constant over time. But in reality, company's sensitivity to the market changes with economic condition. So beta is actually unstable. This creates a problem. Using past data may lead long predictions and misinterpreting. Another important question is why the risk premium on an individual asset is determined by its covariance rather than its own variance. The possible solution is since the market portfolio is already efficient, the riskiness of an asset is not measured by its total volatility, that means variance, but by how much it contributes to the risk of the market portfolio, covariance. Thus, the risk premium is strictly proportional to beta I. Now let's move to the security market line or SML. The security market line is a graphical representation of the capital asset pricing model. It shows the expected return as a linear function of beta. It shows the relationship between risk beta and expected return. Let's understand the graph carefully. On the horizontal axis, we have beta, and on the vertical axis, we have expected return. Now, when beta is equal to 0, return is equal to risk-free rate R, this which represents the intercept. When beta is equal to 1, return is equal to market return. And the slope line is the market risk premium. ERM minus R. The line is upward sloping, means that higher risk lead to higher expected return. This is the fundamental risk-return trade-off. Now let's analyze mispricing. If an asset lies above the security market line, it gives higher return than expected, so it is undervalued. If it lies below the security market line, it gives lower return, so it is overvalued. Investor will buy undervalued assets and sell overvalued assets, and the market will move back to equilibrium. Capital asset pricing model also determine the price of an asset. The core concept is the model allows us to calculate the fair value as zero of an asset today based on future expectation. The pricing equation is S0I is equal to ES1I by 1 plus R plus beta I into ERM minus R. This means the current price equals expected future value discounted by a risk-adjusted rate. Now let's compare two ideas. In normal finance, we use a fixed discount rate, and in capital asset pricing model, we use a risk-adjusted rate. So a question arises, how does the risk-adjusted interest rate in pricing differ from the standard deterministic discounting? The answer is the risk-adjusted interest rate 1 plus R plus beta I into ERM minus R, unlike standard discounting, which uses a fixed interest rate 1 plus R, reflects the economic reality that for a given expected future payment, an investor will pay a lower current price if the asset's risk is higher, thereby demanding a higher expected return. This reflects real-world investor behavior. To summarize, capital asset pricing model explains how risk affects return. Beta measures market risk. Security market line shows the risk-return relationship, and only systematic risk is rewarded. Finally, although capital asset pricing model is very powerful, it has limitations. Beta is not stable, markets are not perfect, and other factors are also affect return. So, in practice, capital asset pricing model should be used carefully. Thank you everyone for listening. I hope this presentation helped you understand capital asset pricing model carefully.